The Moody's Investors Service has changed the outlook for Sri Lanka from stable to negative.
The Moody's Investors Service affirmed that Sri Lanka's foreign currency issuer and senior unsecured sovereign ratings at B1 and changed the outlook from stable to negative. Moody's point out two drivers that underpin the change in outlook. One, expectation of a further weakening in some of Sri Lanka's fiscal metrics. Two, the possibility that the effectiveness of the fiscal reforms envisaged by the government may be lower than currently expected. Moody's expects the government's debt burden to increase further from high levels, which could intensify external vulnerabilities and refinancing risks. Moody's expect a more moderate reduction in budget deficits than outlined in the projections published as part of the International Monetary Fund's Extended Fund Facility. Moody's forecasts that the budget deficit will narrow to slightly under 5% of GDP by 2020 from 7.4% in 2015 and compared with 3.5% projected by the IMF as part of the EFF. The report also notes that a number of state-owned enterprises are under financial stress, pointing to sizable contingent liability risk for the government. Some of these risks have already crystallized, with the government taking responsibility for Sri Lankan Airlines unrated liabilities worth Rs 461 billion or around 4% of GDP. These liabilities will inflate government debt at least temporarily. Moody's also believes that funding from the IMF and other international agencies will likely not fully finance the balance of the current account and foreign direct investment.
The market had already adjusted Sri Lanka's risk premium to suit the new rating done by the international rating agencies, and as a result, the current downgrading will not affect Sri Lanka's future international sovereign borrowing. But of course, what the Moody's had given today is a red light given to the government of Sri Lanka, because the downgrading had been done on the basis of their own assessment of the weak budgetary situation and the inadequacy of the foreign funding coming out of the extended fund facility, that is what Sri Lanka has got from the International Monetary Fund. Compared with the enormous foreign exchange liabilities the country is facing. Because of these two reasons, the government has to now take this as a positive step, positive indication, and amend and reform the budgetary budget of the government, increasing its revenue and also reducing the unnecessary extravagant expenditure. But to do so, the government will have to mobilize all the forces within the country under one umbrella in order to direct the country's future reform program to rescue the country from the current economic crisis which the country is facing.